the title for today is like Tech Stocks Deja Vu. And I wanted to talk about what I think is probably the closest resemblance to tech bubble and tech bust. I really do think we're in that kind of, people haven't really talked about it so much yet, but I think we're on the same tracks. The situation is a little bit different now because in 2002 we went into a recession, and then the Federal Reserve, instead of tightening, they did a little bit of easing of the money supply. But this time around, we have a stronger economy, but at the same time the Federal Reserve is tightening. But it's kind of like from a background of valuation, it's kind of the same situation. So I'm sharing my screen right now, and I'm sharing the stock Twilio. And by the way, this is not investment advice. This is just for to put down some examples on our sheet to just show the resemblance of the situation here. So you have Twilio here, and then you have Oracle in 2002. And then with Oracle, you see what happened afterwards. It was like the line kind of was like set, right? Like you had like a line, and then somehow it got interrupted by a massive bubble. and here, well, you don't have so much history because it IPO'd into like 2016, somewhere around that time. So you don't have that. You have like whatever the performance beforehand, but you will likely have a straight line afterwards if the revenues continue to grow and the company continues to perform at an operating level.
I'm interested in, the symmetry is very clear. I'm interested in your choice on the y-axis here of doing plus percentages. I'm sure that's probably what made them look, and that probably captures like the experience of owning this stock, right? Yeah. Rather than like price history kind of tells a story, but percent change is really how the experience was of doing this over time. But curious why you chose that.
So I didn't do it, like this was like a 2-minute research thing. I wasn't sure if this is total return, right? So I wasn't sure if Oracle was paying dividends at that time. So that's why I chose total return.
Yep.
And so this is, I know Twilio doesn't, but like I just didn't know if Oracle did. So this is, it's scary for one aspect. There's a couple of other ones that are even scarier to look at, but there's some big ones that have fallen like enormously. Like these are companies, in my opinion, not Twilio, but like Oracle ended up being a very profitable company that they recovered and everything, but it took years. And so the problem I have here, or the problem I see for the market in general, is like, do people have the patience to hold on for these for years? And what are the choices someone has if they're in this situation? And I kind of want to leave that for you.
They're in the situation of being down in the stock, or they've held the stock and
they've held the stock. Let's say they've held the stock. And
what's the hit? What's the peak to trough hit, like drawdown, max drawdown right here? Is it 70-80%?
We can look at that. Actually, that's a good question you have here. And right now, like this is, we're talking about, like this is right now, right? The drawdown for Twilio is at 79%. The drawdown for PayPal is 75.5. The drawdown for Oracle right now stands at 31. So let's go back to 2000, and because I think we have to go back all the way because we only have Oracle then. And there we go. I mean, the drawdown reached probably like 83%, 84. And then for years, they were still in that drawdown. And it took all the way to 2015, 2014.
Oh my gosh.
Yeah. But if you look at overall, like that investment, and I wish there was a way of doing this, but the total return, if you do from all, right, Oracle, since its IPO, has delivered 131,000%. So, but if you invested at the peak of the bubble, and I'm just gonna eyeball it here. Right, I'm just going to put it like there. You're just up 100%. right? So 25 years off 100%.
Not great.
Not great. No. Valuation matters.
We're talking about a prospective investor who maybe probably is down on a position on a company that they bought for probably fundamental reasons, right? They think that the company's going to outperform expectations and is a great company, is going to stick around, is going to be there. So they want to own the equity, right? You're in a tough spot. But the good news is you can take a tax loss. Congratulations, if you're in a taxable account. So you have a little bit of you don't, unless you are in this much earlier and you're still sitting on a big capital gain, that makes it even harder. And apologies to anyone who's in that position.
My question is, okay, let's talk about taxes for a second. Let's say you have $100,000 tax loss this year. Next year, you have a gain of $30,000. Do you have $70,000 left of losses to take before you reach profit, before you have to pay taxes?
You do not, it depends on, there's some time frame crossover. So like you can't necessarily apply an old an old long-term gain to an old long-term loss to a new short-term gain, for example. So short-term gains can be a little bit harder to offset, but yes, generally you can do that. So if you have some losses or other losses, yeah, if you have some losses, you can use those and you can carry them forward in pretty big numbers. So that could be a useful piece, but that's not really, like, the economics here are more important and the trading is more important, honestly. My take on this is that if you're asking yourself this now, you probably shouldn't have been in this situation. It is probably indicative of a broken process somehow, where if you're surprised by this, if you're surprised that a growth name can drop 70%, you probably need to reassess your expectations or your risk tolerance. Correct. Generally. And you should reassess your process of how you are managing position sizes. And if you're really bullish on the company, you'd be adding.
Correct. That's what I was going to say. If you actually want to shorten the time frame of recovery, you should be adding. That's the key thing. But you have to be certain that this is a recovery name, right? Like, I'm not going to name companies that I own, but I own two of companies that have fallen significantly, and I am confident that these are names that will recover in the future. So it's you can see it with, like, JP Morgan or other companies like that have had similar experiences in different time frames. Look at this, right? You had a massive fall in 2008. Where are you? 2008. Yeah. Here's the drawdown. And it fell, JP Morgan fell 76%. And, it recovered. It eventually did recover. And so during this time frame, your return on capital would have been, decent.
How long did it take to recover? Just in, like, years approximately?
So let's look at the 2008 specifically, which was a financial crisis, right? Like that one, it took, it bottomed around March 2009, and it looks like here it recovered around May 2015, right? So 6 years.
That's a long time to be underwater.
Sure, but like if let's say you doubled the amount invested in 2009, right? And it's hard for me to do like rolling return, or like the
yeah, I know what you mean.
Like because I eventually want to see what the CAGR was
from having bought the dip.
Yeah, you could see the total return here from this period to 2016 2015. I mean, you had almost a 400% return in 6 years.
You know how I view this stuff. I'm not a stock picker. I can't do it. I don't have the comportment. I'm not good at it. I've failed at every stock pick that I've made. General, not everyone, but most of them that I've made, I've failed at. So I always look at this through the lens of factors. And the two factors that I lean on the most are value and momentum. So From a momentum perspective, I do not like to buy stocks that are down 70 or 80%. Those will never find their way into it. And I just looked up a big momentum portfolio that I use. And in the US today, 21% energy minerals, 18% finance, 13% retail, 12% manufacturing. It's got health, industrial, and tech is down at like 8%.
So right? What is here that ETF?
The one that I'm looking at is ticker QMOM.
The problem with momentum, which gets me scared, is when the regime change happens, you got to run.
There's a big element of rebalance timing luck.
Yes.
In momentum strategies. There's depending on what day you decided to trade these can make a big difference. Back to my high level framework. A stock that's down 70% is not going to find its way into a momentum portfolio. I know that. I'll accept that. So on that one, if I have a 2-box checklist, like momentum X, value, on the other hand, is a more fundamental. Does this thing look good compared to its balance sheet, its enterprise value, its earnings, its sales, its free cash flow, all that stuff? I can see myself getting comfortable catching quote unquote falling knives in the value camp. It's not necessarily going to catch cheap growth names, because I don't think, for instance, on like EV to EBITDA, is Twilio ever going to get fundamentally cheap, right? In like the lowest 10% cheapness of the market. Do you think that it will find its way there? Do you think a lot of quality tech names will get all the way down there? Facebook is in there, for the record. Facebook is straight up in the value bucket now. Do you think this stuff can get cheap? Do you think, for instance, quality growth names can fall into a value bucket?
100%. It happened previously. I think it was 2015, 2014.
Yep.
They massively outperformed the market. So I'll tell you where my position is right now. I'm pretty bullish on mega cap tech. Great inflation hedges, broadly growing, revenue, gross profits, great ROICs, return on invested capital, and generally trading at pretty low EV, enterprise value, free cash flow. So the multiples are there, the value is there, and then you just have to realize that over like the 20-year relative PE period, this is kind of a low. So what this indicates is potentially future returns are
multiple expansion.
Yeah, multiple expansion, plus you have the embedded revenue and profit growth. There's a couple of things you should that you worry about in mega cap tech. They could get cheaper. There are revenue headwinds, and there could be new technologies. I think in the area of small to mid cap software, you have PEs that are going to come out and just, raid them. I feel like you have like the PEs are like the Vikings, and the small mid cap are like the English, back in the day, the English farmers, and you're just going to have raids, over and over. And you've started to see this with, I forget, there was a couple of PEs that have bought up. So there's one PE that had bought up a couple of software companies, public software companies.
Taking them private.
Yeah. Up until like the 2020, you had a lot like the software SaaS companies trading at normal valuations. They weren't like crazy. And then this just went, crazy high. I think eventually this, for those types of companies, the 2002 tech bust is a close resemblance. And so what you have, again, is the same situation. Those companies that can turn a profit and become cash flow positive and cut down on expenses will likely do well over the long run. And you have indications that tech has gotten the message. I don't know if you actually read about what the CEO of Uber said recently.
I did. He said the market cares about free cash flow. That's what we're going to care about.
Treat hiring as a privilege. Uber will slash spending and marketing incentives to treat hiring as a privilege. It's clear that the market experienced a seismic shift and need to react accordingly. And will now focus on achieving profitability on a free cash flow basis rather than adjusted EBITDA. There's also, they are famous, one of the most famous traders out there. Pretty good timer, David Tepper, covered his NASDAQ short, thinks that selling could be ending. In the 2000 tech bubble bust, there was also a couple of hedge fund investors that claimed the same, and then they just continued for a couple of more months. So treat this with a grain of salt. But however, David Tepper has a good track record.
David Tepper, in the book that I read by Meb Faber about 13F, kind of following, David Tepper's was the best. If he just bought the stocks that he was long and ignored the rest of his portfolio, right? Because in the 13Fs, they only have to disclose their long positions. You could it back tested like a 22% CAGR on his longs, which is insane.
And then it's always darkest before dawn. So whenever you feel in the market that there is an incredible pessimism, that's usually a sign that things are going to turn. I will tell you there's a couple of points against this. Number one is that the Federal Reserve has not even started to do their quantitative tightening. Like they have started to raise rates, but the balance sheet remains ginormous, and that will put pressure on bonds, which will eventually spread across the entire market. And so I honestly think that the 10-year might go up to 3.75%. I don't understand why it has settled kind of at 3% for the last couple of days. So that's kind of like the ongoing pain. I could be wrong. And I hope for the sake of people's returns, I hope I am. Because if it goes up to another 75 basis points, it'll be another round of pain. So that's it. There's a couple of other stocks out there. I'm not going to mention now more stocks, but there's a lot of them that that have mega capped stocks that have come down in price and they're worth looking at.
A 30-year-old Stanford graduate named Do Kwon created an ecosystem around a blockchain called Luna, and the crown jewel of the ecosystem was a algorithmic stablecoin called Terra USD. It's meant to be stable. It's meant to peg to the dollar. It had this fancy way of trying to do that and say that it was going to work. It stopped working recently. Last time I checked, 1 UST, which was supposed to be $1, I think it got as low as maybe 40 cents. It looks like now it's trading at something like 65 cents. I recommend the writing of Matt Levine on this topic. He's the funniest and the best at comparing it to the banking system that it's supposed to be replacing. If you look at the founder's tweets, he's doing things. He's trying to get this back, because this is partially a confidence game, right? This is about everyone's confidence and the demand for Terra, which pays, by the way, functionally a 20% promotional APY.